You're watching Stock Watch this week. I'm Zinati Guma, and joining me to unpack your stock-related questions today via Zoom, Chantal Marx from FNB Wealth and Investments and Roy Mutooni from Sanlam Investments. Be sure to send your questions through via email to stockwatch@bdtv.co.za, via SMS on 41392 or on X at Business Day TV using the hashtag StockWatch. Thank you so much for your time. Let's actually, I guess, maybe recap on what stood out for you this week. Let me start off with you, Chantal.
What stood out for me was just the Trump and more Trump and tariffs and chaos and Brazil and South Africa and Japan and South Korea and now Canada and the European Union and 15 to 25%. And I mean, at some point, it just became very difficult to track. Even copper, that isn't a country, had a tariff laid on it specifically this week. So it's been all about Trump. It's been all about the tariffs. And I think over the last 24 hours, it's been about Trump thinking the market approves of what he is doing right now because the market didn't react. And now the debate is, did the market's decision to, or investors' decisions to just kind of ignore the tariffs for now, with the prospect of it being kicked down the road or perhaps not being as bad as expected, actually emboldened Trump to bring it in, to actually stick to the 1 August deadline and go forward with it.
I'm just waiting for Trump to impose a tariff on me at this point. I'm too poor for that. Roy. It's quite interesting what Chantal is also saying, that the markets were trading at record highs. Even in the FTSE 100 at some point was trading at record highs. What's your take on how the markets have reacted to all of this?
Yeah, absolutely. I think it's very interesting to note how sanguine the market has been. That's one. And second, how solid the hard data has been as well. So the employment picture in the US seems solid. Every number that's come out's been fine. Even though the soft data has been getting increasingly worse, the hard data just doesn't seem to confirm that. And then when you flip the screen on the other side, the Trump people are all calling for rate cuts at a time when the economy is that strong from hard data. So it's very difficult to reconcile all of these things. It's incredibly confusing, and it's not quite clear what's going to break first, if anything breaks, because where we are right now is basically we are in a bull market. We're just heading into a stronger bull market, and all the macro seems to be pointing towards an acceleration rather than a deceleration, which isn't what you'd intuitively think when trade is basically being cut back, uncertainty is being increased as it is right now.
Yeah. Okay. Well, I mean, definitely a sector that we've seen a lot of movement is the commodity sector. I mean, you mentioned copper as well there, Chantal. Is the cycle finally turning on commodities, and is that the main driver, tariffs, or could you say that there's more to the story?
So I think it depends on what commodity you're looking at specifically. When we are looking at gold, for example, the most of the demand comes from central bank buying. There's some retail buying right now. There's safe haven demand that should underpin that price for a fair amount of time, until we get more certainty in the system. But that being said, it's run really hard, and that's why you're probably seeing a little bit more sideways movement from gold. When we're looking at platinum and palladium, that market is going to be in deficit over the next few years. A lot of the suppliers have been pulling back on their production, and the market seems to finally be waking up to that fact. Also, platinum is a precious metal that could be used as an alternative to gold, both in jewelry as well as for investment demand. So that's helping there. With copper, there's some front running at the moment because there's a panic situation with the 50% tariff being implemented on copper, seemingly now the 1st of August. So that means that guys in the US that require the commodity have been kind of pulling in as much copper as they possibly can in an effort to avoid shortages or paying more money for that specific commodity. Whether or not that can be sustained, I think is in debate. I think you'll probably see a pop, you'll see it come down and then return towards kind of the longer term fundamentals. When we look at the other commodity prices, it's also quite interesting. There it'll be a function of global growth and, very importantly, Chinese growth going forward. And that, I think, also hangs in the balance right now. So yeah, I mean, I would tread carefully out there, but I think probably fundamentals look a little bit better for industrial metals than it did a few months ago.
Yeah. Roy, would you be looking for opportunity in the commodity space right now, just like all the buyers that we've been seeing lately?
I think so. And I think the way to think about this is that ever since this whole ESG, Save the Planet mindset came through, you haven't seen much development of deep level mines or of new mines, and it's taking longer and longer for new supply to come online across the board. So what would have required 3.5-4.5% global GDP growth to stimulate mine development probably now only requires 2.5-3% growth, because what you have is no new mines, but demand continuing to grow, even if it's growing slowly. And that's across the board, both industrial metals needed for the new energy sources, precious metals, as we've seen with gold, and platinum as well. So I think by and large, you have a medium-term opportunity here. It's very difficult to get capital to develop these mines. They're very labor-intensive. From an ESG perspective, they're not very constructive to the environment as it stands. So there's a very high bar towards developing new mines. And I think that is an underpin towards commodity prices over medium to longer term. So yes, I think definitely well worth looking at.
All right. Well, let's take a look at Berkshire Hathaway and Reinet. An interesting point that a viewer makes here. They've moved into cash, and basically wondering what that signals. And I mean, Chantal, looking at these companies known to be good allocators of company, but deciding that, you know what, cash is what they are holding on to here. Any thoughts on that?
Yeah, so the reasoning behind the cash move is completely different for both companies. So for Berkshire Hathaway, holding cash is because they are concerned about market levels and probably around market risks, and they're just not seeing the opportunities out there right now. For Reinet, they received an offer for Pension Insurance Corp that they cannot refuse. They were also selling down British American Tobacco for a really long time before they got to a point where they actually pulled the trigger and sold the whole lot. It wasn't a core or long-term investment holding for them anymore. So yeah, I mean, the motivation is a little bit different. So I'd read more into the signal that Berkshire Hathaway is sending from its portfolio management team than I would from what happened with Reinet.
Okay. Different reasons. And the second part of that question is the viewers wondering if this is a prediction of another recession where these companies are maybe a little bit worried about the macroeconomic environment. Roy, your thoughts?
Look, I think Warren Buffett's been very clear about his feel about where market valuations are right now. He's got this ratio about market cap to GDP, and it's as wide as it's been in a very long time. So you can tell the perception is that markets are expensive. In addition, remember, he always says they've got enough money they only want to be involved in elephants, like really, really huge acquisitions, and he's not seeing any of those there. And he's patient. He's more than willing to sit on cash. He will move only for the right opportunity. So I think it's a demonstration of discipline, a perception of value or the absence of it. I don't think so much at market timing in the way you and I would do it, but it's a perception that in the normal places where they look, there isn't that much value. And for the types of investments they want to make, there aren't that many available. So they're more than willing to sit on their hands and wait and see what comes up or what comes through.
And I guess really just drilling into Reinet, because Berkshire Hathaway has had cash in their balance sheet for a while. Raynit, they just got the SOFA, and Chantal, you're saying that they just could not refuse it. But now, what do you make of what they could do with this cash, particularly as we've kind of seen disappointment from investors that maybe it might not come to them?
Yeah, I mean, if that deal goes through, Renet's going to be 80% cash, right? And it's actually trading at a discount to that cash that's coming in. So certainly it's a really interesting one. But the debate is: are they going to buy something new? Are they going to invest in something new? It'll have to be a rather sizable acquisition. Have they identified anything prior to accepting that offer? Are they going to deploy that money into the funds that they are invested in that basically makes up the rest of the 20% of their net asset value? In which case, I don't know if that really adds a lot of value to investors and if it justifies that management fee. So there's a chance that they'll do something like that, but it will irk investors. Then there's also the chance that they decide that it's probably time to wrap up the vehicle if they can't see any opportunity out there. And in that case, it becomes quite interesting from a valuation perspective, because now you've already got the company trading at a discount to its net asset value. One of the biggest reasons these types of companies trade at a discount to net asset value is because their management fees are being discounted into the price into perpetuity. And if you expect that management fee to disappear because the stock is being wound up, suddenly it offers a lot of value. But we don't know what they are going to do. So there's quite a bit of risk attached to it.
Roy, I mean, just looking at what is happening right now, could there be some sort of opportunity then to get into Raynit to kind of, investors are hoping for some kind of value unlock, some kind of opportunity in terms of what they could do with this cash?
So the value unlock has happened. If you think about it, the assets were trading at a deep discount. They've been marked up to cash, and they're sitting on the portfolio. Well, eventually you have cash sitting on the portfolio, and cash has only one value. So you'll have 80% cash, 20% in a variety of private equity investments and the like. So by going in right now, what you're betting on effectively is on the next act. First of all, that you'll get cash, or that they'll get something that is well worth replacing Pension Corp. Now, it's difficult to perceive, but like Chantal says, I guess these are big investors who scour opportunities across the world. Maybe that happens. But like we saw with Tencent in Naspers process, you can never guarantee that just because you scored once, that the next act and the act after that is going to work out. So I think at these levels, you're probably well worth waiting and seeing, watching and seeing what happens. I think the first step is let the cash crystallize, let the deal actually happen, and then hear what they're saying. In their announcement, they had said that the money will be applied to the regular investment process that they've been going through. It's very difficult to understand what the next step is. So in my mind, I'd rather, if I hold the shares, I'd rather just sit on the sidelines, wait and see.
A interesting picture here on tech software stocks in SA. Your take on data tech and Bytes. Has Bytes bitten the dust and in the doldrums? Actually, starting off with you, Roy. We had that huge plunge in the share price, and I think the only upward movement I saw on any day was less than 3%, but really still in the doldrums. What do you make of where the share has landed, but also how does it come back?
Look, the thing is, I think there was a disconnect between management guidance and what came out. And I think the market was already concerned about the impact of the changed incentives from Microsoft and all of that, and it came true. What management are basically saying is, no, it's only been delayed. They're going to get the benefit in the second half. But the market's not dumb. When the market sells off a share this much, it will take convincing for it to re-rate back to where it was. The previous share price, the previous peak, priced in a lot of growth and great confidence in management and in management's ability to plan for the business and to see into the medium term and deal with Microsoft. Clearly, a lot of that has been hurt or brought into question, and that's why it's come to these levels. These are relatively cheap levels. I think it's trading on a 14 or 15 times multiple. For the potential and for their market position as the biggest reseller of Microsoft in the UK, I think it can justify a higher multiple, but the market is basically saying, show me why I must give you back the faith I had before. And I guess we'll only see that when the results come out.
Chantal, let me hit you with data tech.
Yeah, I mean, data tech has very quietly become one of the most boring companies on the JSE.
Which is good.
Which is a good thing. It is a good thing. Because they made quite a few disposals a few years ago, returned quite a bit of capital to shareholders, and quietly went about their business in Westcon and Logicalis, or the parts of those businesses that they had left. And yeah, I mean, they continue to execute quite well. We've seen recent results and trading updates pointing to continued decent growth from the major jurisdictions being Europe and South America. And insiders have been buying, I think, is another thing to mention on data tech. The stock isn't expensive. They pay a huge chunky dividend every year. So it offers a really attractive dividend yield as well. So, yeah, I mean, it's not the most exciting stock in the world. Definitely not. But I think it's decent from a valuation perspective, and probably a nice kind of diversifier in your portfolio.
All right. Well, let's go into property. Your thoughts on mass, is it mass or mass real estate? I can never get it right. And yeah, the viewer saying that mass consistently delivers strong like-for-like rental growth and was expected to resume paying dividends. I'm a long-term holder of it and would actually prefer mass to remain listed rather than taken by prime or a high prop. Roy, is this one that you've been paying close attention to, especially the fact that Hyprop has also been raising money to see if they can take over MAS real estate?
Look, there's many questions around this one. Remember, first of all, there's there's a bunch of institutional investors who've asked for an EGM to remove directors. They think there's persistent governance concerns. There's things going on here, I think. And I think when you have issues such as these, if you're a holder, I think it's very important to develop a view as to where you stand, because there's going to be votes, and these guys want to remove some shareholders and bring, not shareholders, they want to remove some directors and bring in some new independent directors as well, basically changing the direction. Then there's the corporate action of going into that structure that will involve Hyprop as well. This is all complicated stuff. And I think at this point in time, it just points to vibrancy in property. And if what we're talking about is vibrancy in property, I'd rather look at something that has a solid business model, trusted management, is growing its distribution, doesn't have much dividend, and there's a lot of other stuff there. I know people see opportunity here in the arbitrage between the price and everything, but as a individual retail investor, the likelihood that you have access to that information at the same time as all these big institutions, I think is incredibly low. So I'd say tread very carefully in what you do with regards to this one.
Yeah, it's actually quite interesting looking at the picture holistically as well, with the, probably governance issues and the potential corporate action. Chantal, how would you be looking at mass real estate?
Yeah, MAS is one of those property companies that still has a very convoluted structure. Like South African property companies generally had very strange kind of corporate structures back in the day, lots of cross-holding stuff, development, joint ventures, and all the rest of it. And MAS is one of those that actually still operates in a very confusing way. What they're trying to achieve right now is to simplify the structure. But there is some pushback against that. And then there are all these opposing parties that are also interested in taking over MAS. I see a way forward or a point in the future where the structure is simplified and we have a better understanding of what is actually going on and better earnings visibility and by extension distribution visibility for MAS. MAS itself, the property portfolio within MAS is really solid and has delivered very well. MAS doesn't have a lot of debt, so that already helps from a risk perspective. I think if you're a holder, I'd probably keep holding it. There will be a point of resolution, and if there's a takeover, you could actually see a really nice value unlock for yourself as well. But yeah, I mean, I don't think it's worthwhile getting involved if you don't own it yet.
All right. Well, I have two questions from one viewer. So, Roy, I'm going to give you Afrimat, and Chantal, I'm going to give you Cash Build. Afrimat, Roy, has been under pressure, but I mean, with what we're seeing in the commodity prices, could we also see a shift in Afrimat to the upside?
Yeah, absolutely. I think there's a strong component of iron ore pricing there. There's also the issue around the turnaround of Lafarge and it beginning to operate like a normal cement company. And you've got management who, I think, know what they're doing and have a good solid track record of buying assets, integrating them, restructuring businesses, and getting them to grow profits. So I really think the bottom is somewhere near here. Yes, it has disappointed. Yes, the share price has been coming down for a long time, but I would always back this management team. I don't think they've bitten off too much. I just think it was a coincidence of getting in a big asset that was underperforming and a poor point in the commodity cycle.
Yeah, and as we speak, that share up 4%. Chantal, Cash Build, you have chosen this as your stock pick before, and actually, I think JP chose Italtal as his stock pick, and somebody was asking about these building materials. Retail stocks, and it seems that there may be some shifts there, some sort of buying activity. Is there hope that we could see a turnaround, even though the economy does still remain subdued?
So that's exactly the thing, right? Building materials and hardware perform well in a growing economy, and they perform well when consumer confidence and business confidence is high. So that's why we saw a really nice pop up in these businesses, and indeed hardware retailer sales in the retail sales numbers towards the end of last year, because we had the start of the GNU, everything was kind of bumping along. Trump wasn't elected yet and didn't hate South Africa, and the US didn't hate South Africa yet. So these companies started performing better. We saw sales increase quite nicely and the share price performance has followed. And then you get kind of a situation that we're in right now, where confidence has actually come under quite a bit of pressure. And I can track that back to about February, when the VAT story first broke. It was the VAT story, then the fragility of the GNU, then the US, the utterances of Trump towards South Africa, and confidence just kind of waned. So my thinking is, from a longer term perspective, I would expect South Africa's economic growth rate to improve, because we do have structural reforms being implemented, even though it's taking a little bit longer than expected. I would anticipate an improvement in our long-term growth rate going forward. And for that reason, I would still be happy to be invested in these companies longer term. Cash Build, I really like. I think that they're proper operators, and they are trying to move towards further consolidating that industry that's still very, very fragmented. But yeah, I think it could be tough going until we get that confidence coming through in the economy.
All right. Well, let us check in with where you are seeing opportunity today. Roy, your stock pick.
My stock pick for today is Glencore. Like we mentioned earlier on, I think there's some upside over the medium term in the commodity sector. Glencore is uniquely positioned here because it's an integrated natural resources company. They're in a whole lot of commodities such as copper, cobalt, zinc, nickel, thermal coal. And I think more importantly, they're also involved in trading these commodities, which acts as a buffer to the variability in the commodity prices. So I think at the current valuation levels, with the outlook that we have and seeing where global growth is going, I think an investment in a diversified miner such as Glencore offers upside to the patient investor.
All right. Where are you seeing upside today, Chantal?
So I am seeing upside in the South African listed construction space. I think if we look at how many players have actually exited that space over the last few years, and we could start seeing really big infrastructure projects. Well, we've already started seeing that coming through from the likes of a Sunroll, but a real concerted effort by government to drive increased investment in water infrastructure and a whole lot of other big projects coming online. I see value in both Raubex as well as Wilson Bailey Homes. Both companies are well run. Wilson Bailey's portfolio has been cleaned up. It's no longer in the Australian business. Their balance sheet has been repaired, and that stock has been a chronic underperformer relative to my favorite, Raubex, for quite some time. So I'm invested in the SA construction space. I do like Raubex as well, but my pick for today is Wilson Bailey.
All right. Well, thank you so much for your time today and your analysis, lady and gent. Please do enjoy your weekend. Those are my guests, Chantal Marx from FNB Wealth and Investments and Roy Mutooni from Sanlam Investments. Do remember that Stockwatch pre-records on a Monday and Wednesday at 1 p.m. and is live at 6:30 p.m. on a Tuesday and Thursday, while Stockwatch this week is live at 12:30 p.m. on Fridays. Keep that in mind and keep your questions coming. For now, that's all from Stockwatch this week, but do stay tuned for lots more coming up right here on Business Day TV.